Tesla is a unique company in many ways, with its CEO, or Technoking as his official title is, Elon Musk at the helm. Tesla's stock is extremely volatile and has seen years where the share price has increased more than 700% in a single year. In one year where the stock price dropped 60% in a year. The controversy is not limited to its share price. As a company, Tesla is different than the other enterprise companies. It's vastly innovative, and it's not afraid to go its own way to achieve its goals. In our last video, we introduced Warren Buffett's method to evaluate and calculate the intrinsic value of a company. Today, we'll use this method to estimate a fair value of Tesla. This is investing in a nutshell. Before we start with the 7 steps from Warren Buffett's method, we must introduce what Tesla is, in case you don't know. Tesla's mission statement is to accelerate the advent of sustainable energy. In essence, this means that Tesla is building a world powered by solar energy, running on batteries, and transported by electric vehicles. Tesla does lots of things, but their main impact as of 2023 is their cars and energy storage solutions. It's fair to argue that as of today, Tesla is one of the leading manufacturing companies in the world, building batteries and battery packs that they assemble in cars and grid-scale energy storage solutions. But Tesla does far more than this. They've created a software solution called Full Self-Driving, also known as FSD. It's currently in beta state, running in approximately 200,000 cars, and the hope is that one day it'll be able to operate without supervision from a human driver. Tesla has their own solar roof systems that can be installed in houses in combination with a large battery. This will enable homeowners to generate their own electricity, reducing the energy bill and giving them a backup solution in case of blackout events. As part of their grid-scale energy solution, they've created several advanced software solutions. For instance, energy arbitrage and more, to enable their clients to save money. The list goes on and includes new hardware solutions for AI training centers, creating bots, HVAC systems, and so forth. Many investors struggle to assign a fair value for Tesla, given the vast array of different innovations and ventures they undertake. In addition, Tesla is always seeking to vertically integrate where they can, to reduce cost and control the supply chain. It's difficult to estimate their future earnings in most of these areas. When will FSD be solved? How much will people pay for it? How much can a fleet of millions of robo-taxis make Tesla each year? We can simplify the equation by looking at their 3 current main income sources: making cars, which includes selling FSD as an option, energy solutions, and services on the existing fleet of cars. The last part also includes their charging network, called Tesla Superchargers. We want to estimate a fair value for Tesla using Warren Buffett's method. Warren Buffett is known to be highly conservative and only include elements of the company that are proven and generate cash flow now. Therefore, we will not include any potential profits from FSD, robotaxis, solar roofs, HVAC systems, autonomous robots, or their charging network. In our model, we will only include 2 things: income from selling cars, excluding FSD, and energy storage solutions. It can therefore be argued that our valuation is conservative, but we leave that to the audience. Step 1 and 2, owner's earnings and growth rate. In Warren Buffett's typical method, you start by calculating the owner's earnings and apply a growth rate for the next 5 or 10 years. This is a simplification applied because it is difficult to estimate the revenue and profits of any company going 10 years forward. In the case of Tesla, they're transparent on their long-term goals and have a track record of achieving them. One example is the long-term goals they announced in 2013. Tesla stated that they aim for a production of 500,000 cars in 2020. They ended up producing 499,550, missing their goal with less than 0.1%. In addition, we've been tracking Tesla deeply for the last 4 years in order to gain an understanding on how the business operates and where they're heading. Since we have this deep knowledge, we will instead estimate the owner's earnings per year from 2023 till 2032. We believe this figure will be more accurate than assigning a growth rate. For the record, Tesla has stated for years that they aim for an annualized average growth in vehicle production of 50% or more. In addition, they have also stated that they aim for a production of 20 million cars a year in 2030. When it comes to energy storage, Tesla has stated that this part of the business will grow faster than the car business, and they aim for an annual production of 1.5 terawatt hours, which is 1,500 gigawatt hours of energy storage in 2030. Let's start by analyzing the car manufacturing business. We've estimated their production based on the current factories, their ramp to volume production, the announced factories, and their long-term predictions. Based on this, we have the following production estimates in our base case. 2.2 million cars in 2023, 3 million cars in 2024, 4.2 million cars in 2025, 5.6 million cars in 2026, 7.9 million cars in 2027, 10.5 million cars in 2028, 13.8 million cars in 2029, 16.7 million cars in 2030, meaning we think they will fall short of their target by 3.3 million cars, 19.6 million cars in 2031, 20.9 million cars in 2032, 2 years after their stated goal for when they should produce 20 million cars. Some will argue that even if Tesla is able to produce all these cars, how do we know if they can sell them all? We need an entire video to explain the answer in detail, but the short answer is that Tesla is able to manufacture electric cars much cheaper than their competitors, with better features, functionality, and safety. Given these production numbers, we need to estimate the average price per vehicle sold and the gross margin on the vehicles. For reference, the average price per vehicle sold in 2022 was $51,000, and the gross margin, 28.5%, while ramping 2 new factories and struggling with COVID shutdowns in China and worldwide inflation on commodities. Based on this, we have the following estimated average selling price, revenue, gross margin, and gross profit from vehicle sales per year. We estimate that Tesla in 2023 will have $30 billion in gross profit just from vehicle sales. And as you can see from this table, we think it'll increase to more than $250 billion in a single year in 2032. Doing the same exercise to the energy storage business, we have the following numbers. In 2023, we believe they will deliver 16 gigawatt hours of storage at a price of $500 per kilowatt hour. That results in $8 billion in revenue. The profit margin will be slim at first, at just 15%. But growing over the next 5 years to 40%. The main driver behind the improved margins is something called economies of scale. When production increases, the fixed costs will be shared among more units, resulting in lower costs per unit produced. The resulting profit will be a mere $1.2 billion in 2023, if we're correct, and won't meaningfully impact Tesla's bottom line before 2025. When we think energy storage could result in $9.6 billion in profit. Towards the end of this decade, energy will become as profitable as the car business, leading to $240 billion of profit in 2032. We should also note that Tesla's goal of 1,500 gigawatt hours in 2030 seems too optimistic to us. We have 534 gigawatt hours in our valuations, just 1/3 of the stated goal. Even in our bull case, they will fall short of this target, but more on that later. We now have the estimated gross profit from both vehicle and energy storage. By also estimating the operating expenses and maintenance capital expenditures, we can calculate the owner's earnings. Tesla is extremely good at keeping their operating expenses low as they grow, and we believe they will continue to do so going forward. This leads us to the following results from Step 1 and 2. $21 billion in owner's earnings in 2023, $31 billion in 2024, $50 billion in 2025, $72 billion in 2026, passing $100 billion in 2027, $152 billion in 2028, $208 billion in 2029, $273 billion in 2030, $355 billion in 2031. A staggering $450 billion in owner's earnings in 2032. Step 3. Discount factor. This step is much easier than the previous one. We will use Warren's preferred method, which is to check the interest rate for the 10-year Treasuries bond. As of the recording of this video, that rate is 3.95%. Step 4. Terminal value. In order to stay conservative, we will assign a 0 value as the terminal value for Tesla. This is obtusely not a correct terminal value, if the business is generating $500 billion in gross profits each year. But we believe it's important to stay conservative to reduce the impact of any optimistic bias in our evaluation from Step 1 and 2. Step 5. The intrinsic value. We've come to the fun part, calculating the intrinsic value based on the owner's earnings, the discount factor, and the terminal value. Since we've assigned a zero value for the terminal value, all we need to do is apply the discount factor to the estimated owner's earnings to find the present value of the future earnings. From this table, you can see the estimated owner's earnings per year and the resulting present value. For instance, in 2032, we reduce the value of the $450 billion we have estimated in earnings to just $317 billion in current value. This gives us a current value of future owners' earnings for the next 10 years of $1,330 billion, an insane amount of future earnings if we're correct. There are currently 3.16 billion shares in circulation, resulting in a fair share price of $421, or $420.99 if you prefer to use 420 when you can. If you're confused, Elon's favorite numbers are 69 and 420. Based on Warren Buffett's methods and our own estimates for owners' earnings, a fair value for Tesla's share price is $420 per share. But we're not done yet. There are 2 critical steps left. Step 6. Scenario analysis. As stated in Warren Buffett's method, we must calculate different scenarios, and we have. We've done the same exercise to calculate a bear case and a bull case. This video would be too long if we were to give the full walkthrough of each model, but if you want us to create a separate video going through our bear and bull case, comment Tesla bull case in the comment section. In our bear case, we estimate the fair share price to be $234 per share and $651 in the bull case. We will assign a 25% weight to the bear and the bull case and 50% to our base case. This results in a fair price based on the various scenarios to be $432 per share. This leaves us with the last step. Step 7. Margin of safety. It's difficult to say what a fair margin of safety should be, but Warren Buffett prefers 30% or more. If we apply a 30% margin of safety to the fair price calculated using different scenarios, we will end up with a buy signal at $302 and a sell signal at $561 per share. What does this mean? Well, in essence, based on Warren Buffett's method and our own estimates, we think Tesla is a good long-term investment if you can buy it for less than $302 per share. Note, however, even though we have spent years analyzing and learning about Tesla as a company, we might be wrong in our estimates. This video is meant as a practical walkthrough of Warren Buffett's method and not for investment advice. Always do your own research and calculations before making any investments. Thanks for watching. See you in the next one.